Greetings, folks. In the world of investing, few books are as revered as The Intelligent Investor by Benjamin Graham. First published in 1949, its wisdom has weathered countless market cycles, proving its enduring relevance. Join me as we delve into Graham's philosophy, illustrated by historical events and contemporary examples. Before we dive into investing, we need to distinguish between an investor and a speculator. An investor prioritizes thorough analysis, focuses on long-term performance, and seeks a margin of safety. A speculator, on the other hand, is driven by short-term market fluctuations, often relying on tips and rumors. Take the dot-com bubble of the late 1990s, for instance. Speculators poured money into companies with little to no earnings, driving prices to unsustainable levels. Investors, guided by Graham's principles, recognize the disconnect between valuations and underlying value. Successful investing is about owning a piece of a great business at a fair price, not chasing the next hot stock tip. One of Graham's most enduring concepts is the allegory of Mr. Market. Imagine Mr. Market as an emotional fellow who shows up at your doorstep every day, offering to buy or sell you shares of businesses. Some days Mr. Market is euphoric, and his quotes for your shares will be sky high. On other days, he's gripped by fear, practically begging you to sell your shares at bargain basement prices. The key takeaway is that Mr. Market's mood swings are irrelevant to the true value of the businesses you own. Let me illustrate this with the 2008 financial crisis. As panic swept through the markets, Mr. Market, in a state of despair, was practically giving away shares of solid businesses. Those who panicked and sold at the bottom locked in significant losses. However, the intelligent investor saw an opportunity to acquire undervalued assets. Remember, Mr. Market is there to serve you, not to guide you. By understanding his emotional nature and focusing on the intrinsic value of your holdings, you can capitalize on his irrationality. This approach positions you for long-term success. The intelligent investor recognizes that market fluctuations are opportunities, not threats. Stay focused on the intrinsic value and let Mr. Market's irrationality work in your favor. In the unpredictable world of investing, even meticulous analysis can't eliminate all risks. That's where Graham's concept of margin of safety comes into play. Think of it as a buffer to protect your investment from unforeseen circumstances. The margin of safety is the difference between the price you pay for a stock and its intrinsic value. The wider the margin, the greater your protection against potential losses. The COVID-19 market crash in early 2020 provides a prime example. For those who had maintained a margin of safety, the downturn presented an opportunity to acquire quality businesses at a discount. They understood that while the pandemic posed challenges, it didn't change the long-term value of these companies. We've talked about buying businesses at a discount, but how do we determine a fair price? That's where intrinsic value comes into play. Intrinsic value represents the true worth of a business, based on its assets, earnings potential, and future cash flows. Determining a company's intrinsic value requires careful analysis of its financial statements, competitive landscape, and management team. Let's take Amazon as an example. In its early years, Amazon was a fledgling online bookstore with minimal profits. However, those who delved deeper recognized Amazon's potential to revolutionize retail. They saw beyond the current earnings and envisioned a future where Amazon dominated e-commerce and more. They understood that Amazon's intrinsic value far exceeded its current market price, and their foresight was rewarded. Not all investors are created equal. Graham distinguishes between two main types of investors, defensive and enterprising. The defensive investor prioritizes safety and stability, seeking to protect their capital with steady returns. This approach suits those who lack the time or inclination to actively manage their investments. Index funds, which track a specific market index, are often a cornerstone of the defensive investor's portfolio. The enterprising investor, on the other hand, is willing to dedicate more time and effort to their investments in pursuit of higher returns. They are comfortable delving into financial statements and seeking out undervalued opportunities. However, even for the enterprising investor, Graham emphasizes the importance of thorough analysis, a margin of safety, and a long-term perspective. The 2008 financial crisis highlighted the importance of this distinction, as those who stuck to defensive principles weathered the storm far better. Even the most skilled investors can't predict the future with certainty. That's why diversification, the practice of spreading your investments across different asset classes, industries, and geographies, is essential. Think of it like this: you wouldn't put all your eggs in one basket. The 2000 to 2002 bear market, which followed the dot-com bubble, provides a compelling example of diversification's importance. Technology stocks crashed, but those who had diversified their portfolios across other sectors were better insulated. Diversification is not about picking the next winning stock or sector. It's about managing risk and ensuring that your portfolio can withstand the inevitable ups and downs of the market. The stock market is a fickle beast, prone to wild swings driven by news headlines and investor sentiment. The key to long-term success lies in not overreacting to these short-term fluctuations. Remember Mr. Market? He's always going to be there, offering you prices that may or may not reflect the true value of your holdings. The 1987 stock market crash, often referred to as Black Monday, is a prime example of the market's tendency to overreact. On October 19, 1987, the Dow Jones Industrial Average plunged by over 22% in a single day. Panic ensued, and many investors sold their holdings at fire sale prices. However, those who kept their cool and rode out the storm were rewarded. The market recovered, and those who had sold at the bottom missed out on the subsequent rebound. Investing is as much about managing your emotions as it is about analyzing numbers. Fear and greed are powerful forces that can lead even the most intelligent investors astray. The GameStop short squeeze in early 2021 illustrates the dangers of emotional investing. Fueled by social media hype, retail investors piled into GameStop stock, driving its price to astronomical levels. However, this frenzy was detached from any fundamental analysis of the company's prospects. As quickly as it rose, GameStop's stock price crashed back down, leaving many investors nursing heavy losses. Remember, the market is not a casino. By staying disciplined, focusing on the fundamentals and not getting swept up in the hype, you can avoid costly emotional decisions. Throughout this journey, we've emphasized the importance of distinguishing between investment and speculation. Investing involves thorough analysis, a long-term perspective, and a focus on intrinsic value. The cryptocurrency boom and bust is a prime example of the dangers of speculation. Bitcoin, Ethereum, and other cryptocurrencies captured the imagination of investors worldwide, driven more by hype than by tangible fundamentals. As with any bubble, the inevitable burst was painful for those who had mistaken speculation for investment. Remember, the key to successful investing is to stay grounded, focus on the fundamentals, and avoid the allure of get-rich-quick schemes. Let's delve into one final case study that exemplifies the power of Graham's approach: Warren Buffett's investment in Coca-Cola. In the 1980s, Coca-Cola was already a well-established brand with a global reach. However, its stock price had languished for years, considered by many to be a slow-growth, mature business. Buffett recognized the enduring value of Coca-Cola's brand, its wide moat, and its consistent cash flow generation. He saw an opportunity to acquire a high-quality business at a reasonable price. Over the years, Coca-Cola has proven to be one of Buffett's most successful investments, generating substantial returns. This case study highlights the importance of looking beyond short-term market fluctuations and focusing on the long-term fundamentals of a business. Successful investing is about identifying undervalued assets, owning a piece of great businesses, and letting the power of compounding work its magic over time. As we conclude our exploration of the intelligent investor, I hope you've gained valuable insights into the timeless principles that underpin successful investing. It's about making sound, rational decisions based on a deep understanding of a business and its intrinsic value. Focus on value, be patient, minimize risk, and stay disciplined. The principles of intelligent investing will guide you towards your financial goals. So go forth, invest wisely, and remember, the greatest investment you can make is in yourself and your financial education.